Good afternoon, ladies and gentlemen. I want to thank you for taking time on your day and getting on for the Thrivent product. Very interesting, nice product to add to your portfolio. If you don't have it, I think after seeing the presentation today, you'll want to add it. We'll show you different ways to do that. Easiest way is to call Golden Care or email us at marketing@goldencareusa.com. But again, I want to thank everybody for taking time out of their day and getting on. Today we have our presenter, Craig Roars. He's the head of the marketing for Thrivent's long-term care independent distribution. That was easy for me to say. He's been in the industry for 22 years, focused all on long-term care planning. He has helped thousands of agents market and discuss extended care planning with their clients. He's also on the state of Minnesota's Own Your Future advisory panel. If you remember when that came out, it was a great push in the long-term care market. We're still getting a lot of good use out of it. So thank you, Craig, for your work on that. He's been featured in NAIFA's Advisor Today magazine. And you know what? He's just a great guy. He's been around the industry forever. He's well known by a lot of the people. We work very close with him these days. And today is going to be walking us through the latest additions to their long-term care solutions, which is Thrivent Long-Term Care Insurance. And I don't want to steal any of his thunder, so with that, I'm going to turn it over to Craig. Craig, thank you very much for getting on today and talking with our agents.
Well, thanks for having me, John, and thank you everyone for joining us today. I hope to share with you some really exciting news. If you've been on Golden Care's previous presentation on Thrivent, you're going to hear a little bit of the same stuff, so maybe a refresher, but a lot of new additions since that first presentation. And if this is your first introduction, welcome to Thrivent Long-Term Care. I think you're going to find this to be a great addition to your portfolio. There's a lot of spots where you're going to find us to be a great fit. So we're not going to, be your one-size-fits-all solution for everybody. But I think if you give us a test drive, you're going to like what you see, and you're going to start looking to us more and more often. So with that, you are now able to offer what I believe is one of the most benefit-rich standalone solutions on the market that happens to be backed by the strength and stability of the country's largest fraternal insurer, Thrivent Financial. And actually, there's no better time than right now to start talking about Thrivent, because starting actually just this last Monday, 2 days ago, Thrivent launched its first ever nationwide ad campaign all over internet, TV, newspapers, radio. They're spending, I believe, $35 million through the remainder of the year to raise brand awareness around Thrivent. So what that's going to mean is people are going to become more aware of Thrivent, who they are, what they mean, things like that. So you are actually going to have a advantage over like somebody's local Thrivent rep, in that they can only offer Thrivent long-term care. You can offer Thrivent. You can offer all the other carriers that are available to you through Golden Care. So you now have a really extensive toolbox full of solutions. This ad campaign, it launched Monday with full-page ads in the Wall Street Journal and some other large papers. They had TV spots on Today, Live with Kelly and Ryan, America's Got Talent, and other shows that you're going to see throughout this week and next week for sure on both broadcast and cable TV. But people are going to become more aware of Thrivent. So just the fact that you're able to offer them as a solution just makes you look like you have more options with one phone call than if they went around to all these independent producers themselves. So today, I'm working on the assumption that most of you are very well versed in the standard features and benefits in a long-term care policy. So the goal isn't to walk you through how each and every one of these necessarily works as far as a long-term care 101 kind of session, but to really show you where our differentiators are and to show you how to position Thrivent. And then at the end, I'm going to touch on some sweet spots that we've really discovered in the past couple of months, and really discuss our incentive for you to give Thrivent a test drive. And so I apologize in advance. I'm going to cover a lot in the next few minutes. I believe this is being recorded, though, and I'm going to make sure to get Golden Care a copy of the materials that are referenced in this. So don't worry about scribbling frantically at times, because I am a fast talker, because there's a lot to go through here. So if you're on the East Coast, you'll hang with me just fine. Everybody else, I apologize in advance. I talk a bit quick at times. So first off, who is Thrivent? We are the world's largest fraternal organization. And for those not familiar with what a fraternal is, it's an insurer where it's a not-for-profit organization that has a membership, and all of the members share a common bond. And so with Thrivent, all of our members, their common bond is that they are Christian. So while some of you may have known us previously as Thrivent Financial for Lutherans, they made this change in 2014 to open up membership more broadly to anyone who identifies as Christian. And I'll really explain at the end of this presentation what that means, what they have to do to apply for membership as a Christian, and how to position this so you don't offend anyone, whether, you know, if you don't know their faith going into a conversation. I'll make it really simple, but I save it for one of the last things. Next, I don't want to talk about it throughout, but because it's one of the last things I want you to walk out of here with a really clear understanding on. So think of it maybe more as Thrivent is like a financial cooperative. So we're not a religious organization selling financial products. We are a financial organization selling insurance products to a membership that is Christian. So think of it more as a financial cooperative, because all of the members or policyholders are owners of the company. So as such, we are not a stock company, and that's important to a lot of people because we're not beholden to stockholder interest or profits every 90 days. So Thrivent can play the long game with investments and things like that. So we're much more like a mutual company. So think of a fraternal as a mutual, but I like to actually call it maybe a mutual plus. The plus being that for fraternal's not-for-profit tax-exempt status, Thrivent is required by law to give back to the communities. So as such, we are the country's largest supporter of Habitat for Humanity, and you've very likely seen people out in your communities wearing these Thrivent Live Generously t-shirts that you see on the screen here that people wear when they're out doing various service projects. All of those projects are funded in some way, shape, or form by Thrivent contributions as they're giving back to the communities. Oftentimes they'll do it as a little Kickstarter program where if you're a Thrivent member, every year you get a $250 gift card to kickstart your pet project that gives back. So if you have a cause, you do something for Alzheimer's awareness or whatever, for example, you have a fun run, you can get this $250 gift card. You don't give it right to your charity, but you use it to finance whatever, because they're looking at it as like seed money to grow the $250 into $2,500 or whatever. But that's how Thrivent gives back, is both in direct donations that they do as a large company, but also if you have this cause that you support, and most people do, this is a way to help fund that if you are a member. So it's a great company to work for, but it's also a feel-good one to be part of if you are a policyholder. So I will explain again at the end Thrivent's common bond requirement and how to explain it a little bit easier, because I do want you to explain it really simply and easily for people. But just a little bit more background, if you're new to Thrivent, we are one of the strongest carriers I believe you're going to find out there. Incredibly high ratings from AM Best, where we just got reaffirmed at A++ in May for 2020 rating. We have a Comdex of 99 out of 100. And as you can see, we are the only one of the top 3 highest rated carriers that is available to independent brokers. New York Life and Northwestern Mutual both have equally high ratings, but those are only available to captive agents with those organizations. So you might be wondering, isn't Thrivent new to long-term care? Well, yes and no. So Thrivent began as 2 separate fraternals, Aid Association for Lutherans, AAL, and Lutheran Brotherhood. For those familiar with those 2 organizations, both of them, they began selling long-term care back in 1987 when many carriers got into the industry. And the 2 companies both sold their own products up until 2001, at which point they formed Thrivent Financial, and they stopped selling their own products And for a time, they continued to sell products, but they were from other carriers because they were busy getting their own Thrivent annuities and life insurance and other products off the ground. But because they so firmly believed in solving this problem for people, for families, Thrivent re-entered the market with our own product in 2012. And so we are now on our second generation of product, this one being launched in 2016. And so if you think about it a little bit differently, Thrivent has the benefit of over 30 years of experience in long-term care solutions for our members, as you can see here on the screen, but without perhaps some of that baggage, sometimes negative baggage that comes with the missteps that other carriers made during those same time frames, things on pricing mistakes, underwriting assumptions, lapse assumptions, stuff like that during the late 90s and early 2000s. And so when you're looking at us in the context of other carriers out there, I ask you this. When was the last time that your other carriers repriced their product? I know some other leaders in the industry are still using 2013 pricing. So to me personally, as somebody that's been doing this for 22 years, that is forever in long-term carriers. So that does concern me at times. Our pricing is from 2016. It's priced on very recent underwriting claims, lapse, interest rate assumptions, all that kind of stuff. So keep that in mind when you're looking at things. Don't just always look at price. Look at when was somebody actually repriced. So AAL was formed in 1902 and Lutheran Brotherhood in 1917. So you're actually working with an insurer that has roots that go back over 100 years. It's just a relatively newer name and newer presence in the market as Thrivent. So there have been some increases because we have been doing this for a while on the old Aid Association for Lutherans and Lutheran Brotherhood blocks of business. But as you can see here on the screen and as you see in the leave behind packets for consumers, these are much smaller rate increases than you've seen on some of the business sold, especially by those stock-owned companies during those same time frames where you've seen things up in the triple digits at times. There have been no increases on the Thrivent branded products at all. These products that are available since 2012 and 2016. This is just the old AAL and Lutheran Brotherhood. And when we've averaged these increases on these policies here on the screen and looked at it across all the states, I believe the average came out to about a 23%. So, barely into the double digits versus, again, some of those high double digit or triple digit increases. Thrivent is always looking out because it's member owned. The very last thing they want to do is do anything that negatively impacts their members. So they are very protective of the owners of the company. So for underwriting and claims processing, you'll be happy to know we've teamed with one of the most experienced partners out there, LTC Group, which you are probably very familiar with. If you're selling any of the other carriers out there, they work with most of the other leading carriers, and so they handle all of our claims and all of our pre-screening and underwriting. So it's a group that you can know and trust from your previous experience with them. And then just to kind of give you a context of where we currently fit in the landscape, these are some LIMRA 2019 end-of-year numbers that I pulled for traditional long-term care. And as you can see, with Genworth going on hiatus, mutuals and fraternal carriers now represent the bulk of traditional long-term care sales. And so what does that mean? Is people are looking for strength and stability. They're looking for companies that are a little bit more conservative. People that are going to be here to keep their promises 20, 30, 40, 50 years down the road. So that's where they started to turn to these fraternals and mutuals. And right now you can see Thrivent as the end of last year, we are the 6th largest traditional carrier. And we believe with a lot of traction we've seen in just the past few months, especially partnering with great partners such as Golden Care, that we're going to be moving up a couple of rungs this year, especially as you start to see how benefit-rich this solution is. So to that point, real quickly on this screen, I'm just going to give you a teaser of what we're going to be covering in the next few minutes. I'm going to go into a lot more detail on each of these, but just a real high-level overview before we dive in. Thrivent's differentiators. We cover ages 18 to 79, so right there already makes us different in that some others will only maybe cover between 40 and 75. We cover on both sides of that spread. We have a 5-year rate guarantee built in. Most other carriers no longer offer a rate guarantee, or if they do, it might be a 3-year maximum. I know in the long term, that doesn't mean as much to some people, but for consumers, they like hearing rate guarantees, especially on the traditional products here. Elimination period. Instead of the 1 day equals 1 day towards your elimination period, we have a built-in shortcut of 1 day of care in a week, satisfying an entire week towards the elimination period. We also have a rider that can even shorten that up to a 0 day for home care. We offer really robust benefits. You can go up to an 8-year maximum benefit. You can design a plan with up to a $15,000 a month maximum. And then when it comes to inflation, we can go either the route you're more familiar with, your traditional compounding inflation. With Thrivent, we call them automatic inflation benefits. Here we have 1, 2, 3, and 5% compound. Or we have a flexible increase benefit, a buy-up option. That's going to actually take up several minutes of our conversation today because it is a little bit more detailed, but I want you to understand how it works. We are one of the few carriers on the traditional side offering a 10-pay solution. And then we've got some great riders that you can throw on here too. So we have an additional cash benefit rider, we have a shared care rider, survivorship, return of premium, and a waiver of home care for waiver of elimination period for home care rider. So as you'd expect in a modern traditional long-term care policy, Thrivent covers services and care in a variety of settings, making sure that your clients are going to be able to receive the type of care they want in the location they most prefer. So home care, residential care facilities, adult daycare, all covered. All these contracts have that 5-year rate guarantee that I just mentioned. And this product, because we are a fraternal, you are an owner of the company by owning a policy. As such, if the company is doing really well and they're able to pay dividends, dividends may be available. So these dividends, they aren't guaranteed, but if they are payable, they're going to be applied on an annual basis. And the way that works with Thrivent's long-term care product is you have one option only, and that's to reduce future premiums. So if they pay dividends 1 year, it's going to offset your premiums the next year is the way it works. So I don't personally use the dividend availability as a selling point because we don't know exactly how that's going to play out, but people do like knowing that that is something that could, help offset some of their premiums down the road. And just for your reference at this point, because they're still new products, the 2012 and 2016 products have not yet paid dividends on those two policies yet. The contract is intended to be federally tax qualified, and it's also designed to be partnership eligible where they filed it as such. And the product is available in all states except for New York. And because the question does come up, are they planning to file this in New York at any time? Not at any time in the foreseeable future, unfortunately. We know there's a huge opportunity there population-wise and just with not a lot of product options out there, but Thrivent is not domiciling a company there anytime soon just to launch in New York. So I'll break this next section out into a couple of buckets. First off, we'll talk about the built-in features, and then we'll tackle the riders that'll really let you customize a plan for somebody. So first off, built-in features, we'll talk about the waiver of premium. So once the elimination period is satisfied, your premiums are going to be waived. Or if a couple applies together and has shared care, you're actually going to have a joint waiver of premium where they're going to waive the premium for both people even if only one is receiving benefits at the time. So a great feature right off the bat. We have a built-in care coordinator service. To me, this is always one of the most under-talked about but one of the most beneficial features in any long-term care policy because it helps out the family members, the family caregivers more than anybody by having this kind of feature. So clients are not required to use Thrivent's care coordinator services in order to use their policy benefits, but it's a great feature to have here because any of the expenses for Thrivent's care coordinator services are not going to be reimbursed from the contract itself. Your benefit pool is not going to be dinged, but actually are paid separately by Thrivent to the care coordinator service because they so truly and firmly believe in the value that this brings to families. that they pay this themselves. So you're not going to be dinged for using this, but you also aren't required to use it to access the rest of your policy. So to help with emerging services and technologies, an alternate care provision is included with the policy. Thrivent also offers bed reservation in a facility for up to 60 days per calendar year for any of those short breaks that you might need to take for a family wedding or whatever it might be, that your bed is going to be held. And there is a contingent non-forfeiture benefit built into the policy in the event that there is any kind of substantial premium increase, kind of along the lines of those that we mentioned earlier that other carriers had suffered in the past. So that is built in here as a consumer protection. Thrivent also has what we call ancillary benefits. So these are included in all contracts, and these include things like respite care, equipment and home modification, caregiver training, and the international care benefit. The ancillary benefits are not going to satisfy your elimination period if you use them, and any of these benefits that are paid are going to reduce your total available benefit pool. But each one of these has its own separate benefit limit amount. As you can see here on the screen, it says each of these is equal to 2 times your maximum monthly benefit. So it's not that all the things on this screen have a total of 2 times. It's each one of them will go up. So for respite care benefit, if your informal caregivers need a break for a vacation or any of that self-care that they need to do, they will have a benefit equal to 2 times whatever your maximum monthly benefit is. The same for caregiver training, equipment and home modification. And the reason I'm really talking about this right now is when we get to that final bullet, international care, I know with some carriers, international coverage might cover up to a year of care. If that is incredibly important to somebody, Thrivent might not be the best fit. I like to be totally transparent with people. If that is a primary concern for somebody, Thrivent might not be their best option if they're only going to get 2 months worth of benefits. The international care is going to be available for anything received outside the United States, its territories and possessions, in any places that are not going to violate any UN sanctions or U.S. treaties. So now let's break down some of the basic building blocks that you have with any policy, and the reason we're going to spend some time here is this is another big area where Thrivent does differentiate from our competitors. So first off, elimination period, 30, 90, or 180 days, and again, instead of actual service days that some plans offer, with Thrivent, if you have even 1 day of care in a week, it's going to satisfy that entire week towards your elimination period. It only needs to be satisfied once while your contract is in force. We do have a rider we'll talk about in a little bit that you can make that even shorter. We can design some really robust policies, as I alluded to earlier. While others might cap their monthly maximum at maybe $9,000 or $10,000 a month, Thrivent will start down at $1,500 and go up to $15,000 a month in increments of $100. So you can really do some robust plan design here. Same with benefit multiplier. While others might max out at a policy at maybe 5 or 6 years, Thrivent offers 2, 3, 4, 5, and 8-year benefits. And you can add shared care to any of these. And I'll say this probably a couple of times because I love saying this, and people love hearing it when they're on the consumer side. Take 2 8-year policies, put shared care on it, you have a 16-year shared pool. It's the next best thing to an unlimited benefit. Few people are going to max that out. So the optional riders are going to be those last choices that you make when you're designing a plan. All of these are going to give you all kinds of additional customization. I'm going to talk about our 2 options when it comes to benefit increase. We have annual increase benefits that are going to be what you're most accustomed to when it comes to compounding inflation. You can do 1, 2, 3, or 5% compound. But I'm going to start off talking about our flexible increase benefit. So what this is a 5% compound buy-up option each year. And the way it works is this. First off, it's available to applicants ages 18 to 70. And what it does is it provides an opportunity to increase your monthly pool and your total benefit pool on your contract anniversary by 5% compounded. And it's an all or nothing offer each year that doesn't require any evidence of insurability. So the increase is going to be automatic on your contract anniversary, and this part's important, unless the insured opts out when he or she receives their annual notification letter. So it's not an opt-in where they have to remember to do it. It's an opt-out where if they don't want to do it that year, they just return the thing saying, I don't want to do it this year. The premiums will increase with each offer that is accepted, and each one of those little offers, if they do a buy-up, a 5% buy-up that year, that little chunk is going to be based on their age at the time of the increase. So as such, if you plotted this out over the course of a lifetime and somebody bought up 5% at age 56, 57, 58, 59, it's going to be more expensive than in the long run than if they had bought a traditional 5% compound, because the prices for that are baked in right from the get-go. So it is more costly because you are buying all those little increases at the attained age. So these automatic increases, well, the premiums are going to remain unchanged, first off, if somebody doesn't accept one of those increases. So it's not going to go up in a year when they opt out. These increases, this is going to be an important thing you'll see play out on the next slide, are going to occur and keep building your policy once somebody goes on claim. It's really cool how this actually works. But you might be wondering, okay, well, what are the rules around somebody taking or declining an offer? Well, if 3 consecutive offers are declined, at that point, no future increases are going to be extended to them. However, the rider, the FIB rider, is still going to remain on their contract because the insured is going to be eligible for those automatic increases that are going to occur once they go on claim. And to really show how this plays out, I'm going to walk you through a hypothetical here. So we have a client, her name is Mary. She buys a Thrivent contract when she's 50 years old, and she chose the optional FIB rider because it helped her manage her budget, since the premium increases were going to be dependent upon whether she chose to accept or decline an offer. And for her, this was really important because during a time frame here, she wasn't sure exactly when, but she knew at some point she was going to have some additional outlays, like her children were going to need help paying for college, she needed to remodel the house, those kind of things. So she knew she needed to be able to stay in control of her budget, but at the same time, she wanted to prepare for the future because she had family experience and she saw, that she wanted to have some growth in her policy. So she chose this option. It helped her manage her budget, and she was in the driver's seat when it came to what happened with her policy. So she bought the FIB, and her initial goal when she met with her planner was to buy up whenever she could until her benefit amount reached at least $15,000 a month for the monthly benefit anyway. And so over the next 20 years, we'll start off on the left-hand side of the chart. At age 50, Mary buys the policy, and over the next 20 years, she accepts 13 annual increase offers, and she declines 7. So the red show the buy-ups, and the dark gray are when she declined. However, as you can see, she didn't decline the offer in 3 consecutive years, so that meant she continued to get this offer from Thrivent each year. Jump ahead to when she reaches age 70. At this point, Mary decides that her maximum monthly benefit has reached about that $15,000 a month that she had initially wanted, and she believes this is now going to take care of most of her needs. So at this point, she decides, you know what, I'm going to decline all future increases. So after Mary declined the increase offer 3 years in a row, those 3 dark gray bars in the middle of the chart, she was not offered any future increases. So that's when we go to the light gray. Jump ahead to age 80. At this point, unfortunately, Mary's health goes downhill. She needs to file a claim. Well, at this point, the FIB automatically kicks back in, and her maximum monthly benefit and whatever is left in her benefit pool are going to continue to grow 5% compounded annually each year while she is receiving care. Now note, she is not having to pay for any of those increases, and that's because she has the waiver of premium built into her policy. So she's essentially getting all these increases. That's why you're seeing it tick up in red on the right side of the screen, but she's not having to pay for them at that point. So this can really help draw out somebody's benefit when they're actually truly needing the care. And in the illustration software, you're going to be able to show how the pricing would play out based on different scenarios that somebody might come up with. Somebody might say, okay, I want to take it every other year. I want to take it every third year or whatever. You can really show that in the FIB part of the illustration software. So the FIB, this can be partnership qualified dependent on age in 26 states. As long as you meet the buy-up requirements for that state. You can also we'll provide a full list to Golden Care to share with you, because there are differences between all of the states as far as how many times you can decline it or when you can, things like that. An example is I'm based here in Minnesota. In Minnesota, we are required to accept all FIB offers up through age 75. So in that scenario, Mary would have lost partnership qualification after she declined that first offer there at age 57. So it's really important that you know your state variations, and the Golden Care team will help you with that. So the FIB, where does it fit? It's a great solution for those who have regular or annual reviews with their clients, because you want to make sure they understand the need to continue buying up to maintain that partnership status, or just to keep growing their benefits. So where it's really popular is with Thrivent's captive distribution, because they are having those annual reviews with people. So for them, it makes sense to have this annual discussion with people. What most consumers and producers in particular are probably most comfortable with is our annual increase benefit. These are your traditional compounding inflations of 1, 2, 3, and 5%, where your maximum monthly benefit, your benefit pool, your total pool of money, and any of those ancillary benefits that we mentioned earlier are automatically going to increase on your rider anniversary. However, here the difference is going to be the premiums are going to remain level over time, and that's because the cost of all those increases is already baked into the premium. So as a result, this benefit's going to be a lot more appropriate for people who just want the convenience of making one decision, a one then done, set it and forget it kind of mentality, or who just want to have a level premium for whatever budgeting purposes they have. One thing to note, the 1 and 2% compound inflation are considered partnership qualified, again, depending on age, in over 20 states. And so this can help make partnership coverage be more affordable, as we found premiums to be less expensive if you drop down to a 2 or 1%. And again, you'll have that full list of partnership requirements for all states as a follow-up to this call. But this is where you can be really creative when you're competing against other carriers that might only do a 3% compound. You can do a 2% compound here and maybe give them a more monthly benefit or whatever. Some other items to note, Thrivent was the first carrier to launch partnership policies in Illinois and New Mexico, so we led the pack there, even as a relative newcomer to long-term care. We do not currently offer a partnership option in California. So while we do offer product in California, it is not a California partnership policy. So some optional riders now, and if I mention cost percentages here, these are going to be ballparks because they're going to be impacted by different things like elimination period, marital status, risk class, things like that. And again, I will get these ballparks to the Golden Care team to be able to share with you. Again, go to the quote software if you want the exact numbers for these, but just some ballparks. So first off, we have a cash benefit feature that you can buy with Thrivent. Now, this is going to be different in that it's not a cash alternate option like some carriers offer. This is an additional cash benefit. So here you're going to receive up to your 100% of your benefit as reimbursement, plus you're going to receive an additional cash benefit that's going to help you cover some of those other expenses, or to be able to use for covering things like informal caregiving, things like that. And the use of the cash benefit does not draw down your total benefit pool because this is an additional cash benefit paid on top of whatever is in your benefit pool. So the way it works is if you are receiving home care services, you're going to receive an additional 15% of your maximum monthly benefit paid as cash, or if you're receiving care in a facility, it's going to be equal to 10% of your maximum monthly benefit. And the cost of this rider runs about 16%. I'm speeding up a little bit just because I'm seeing where I'm at on time here. So Your clients don't want to use it or lose it, or you're in a scenario where you're competing against linked benefits, for example. Thrivent does give you some options there. So first off, we have a non-forfeiture rider that's going to provide a paid-up benefit equal to whatever premiums paid into the point that they decide to terminate their coverage. So if they want to, you know, in that live, die, or quit scenario that people talk about, they decide to quit and their policy has been in force for 3 years, they will have a benefit equal to whatever they paid in up to that point. But the cost of adding that rider is going to run about 8%. We do offer a return of premium on death rider that's going to return any premiums paid to the estate at the time of death, minus any claims paid, of course. The thing here to note is the rider must be enforced for 10 years before death occurs to be eligible for payment. And because of that, because it's priced to only trigger if it's enforced for 10 or more years, this does make Thrivent's return of premium, I believe, more affordable than some of the other carriers out there. And the cost of the return of premium rider, this does vary with issue age, but it runs about 25% at age 50 to 49% for somebody age 65. Some riders for couples. We have a shared care. This is not going to be a third pool concept like some might offer. This is going to link together 2 individual contracts. If the insured uses his or her entire available benefit, then they can start drawing from their benefit partner's remaining available benefits. So again, if you couple shared care with an 8-year benefit each, you have a 16-year shared pool, probably the next best thing to an unlimited benefit. If somebody's looking for unlimited, they can't find it, or the cost is extremely expensive with anybody that does offer it, 16 years is going to be pretty unlimited for most couples. So it's a great way to position Thrivent as a solution here. But what if somebody uses all of their benefit? What happens then? Or excuse me, if they use all of the healthy spouse's benefit. Well, at that point, the healthy spouse can elect to purchase a 2-year benefit for his or her use only. No evidence of insurability is going to be required for them, but the new premium is going to be based on their attained age at the point that they have to exercise that option. But because of the reality of most people needing long-term care, maybe in their late 70s or early 80s, this option is going to be something they can exercise up through age 85. What happens if the insured dies? Well, the survivor's benefit is going to be automatically increased by whatever was left in the deceased partner's pool. The cost of the shared care rider is going to be dropped from the policies, but the spousal discount remains in place for the survivor. Now, the cost of this one, it does vary, of course, with benefit multiplier, but a couple of examples. It runs about 25% to link together to 3-year plans, to about 16% to link together to 5-year plans. The survivorship benefit, it's a rider that states if the couple has in-force contracts, riders on both of them for 10 years and one dies, the survivor's contract becomes fully paid up. Survivorship rider costs about 10%. So if your clients want to make it easier for their future caregivers, they might look at a 0-day elimination period by adding our rider for a waiver of elimination period for home care and adult daycare. Any days received under this benefit are going to be applied towards meeting their elimination period in total. So, for example, if they then have to go to facility care, their elimination period doesn't start over. Any of these days are going to count towards that. The waiver of home care elimination period, this is 0-day rider, I think is one of the most affordable in our industry at a 7% markup versus many of the others I believe are closer in the 9 or 10% range, so another differentiator there. Finally, 10 pays, accelerated payment options. Thrivent is one of the only carriers on the traditional side offering a 10-pay option. If you do go down this route, there is a reduction in commission for the agent, and we can get that information to you on what that actually looks to be. It's not available if you go with the FIB rider or the survivorship rider. And one thing I do like to mention here is Thrivent isn't looking to become a 10-pay only carrier for producers. They want this part of their business, their actuaries have looked at things. They only want it to represent about 10% of Thrivent's mix. And right now that number is actually closer to about 5% of what they're selling, so there is room for growth here. However, because of that desire to keep it under 10% of what they sell, they do have a limitation here, and it's only going to be in play if you have 3 or more people that you're going to be submitting for 10 pays at the same time. They do want to get those kind of cases pre-approved. And what I mean by this is not 3 or more that you might submit over a couple of months that are all unrelated cases. It's more if you have a small carve-out you might be doing, maybe a family-owned business where everyone would be able to meet that common bond requirement, and everybody wants to pay with a 10-pay, and you have 10 pays all coming in at the same time. In those instances, Thrivent just wants to pre-approve it. You send a request in to authorize those 10 pays. Just send us an email. We'll get you authorization usually within 24 hours. And to this point, in the 5 years that we've been doing this, none of those requests have been denied. But we do have this formality at this point if submitting a bunch of related 10 pays. Again, if you have one-off 10 pays, no pre-authorization is needed. You have a couple both applying at the same time looking for 10 pays, you don't need that pre-authorization. It's going to be more if you're looking at it almost as a small group kind of setting. So let's talk about potential discounts. People who qualify for a preferred health issue are going to receive a 10% discount. Right now, this accounts for about 25 to 30% of the policies with Thrivent are issued preferred. So we still tell producers standard should be your standard when quoting, especially if uncertain. We do have a great pre-qualification line with LTCG, so anytime there's any health issue, I recommend contacting them. They will give you a really clear indication of if somebody's going to be preferred, standard, or even one of our 2 substandard ratings. But they will give you really clear direction on that. We have 2 types of couples discounts. We have a 20% couples discount if 2 people are applying together and are approved for coverage, or if just one individual already has existing coverage, either from Thrivent or one of those older predecessor fraternals, AAL or Lutheran Brotherhood, and the other person is now applying for Thrivent coverage. They would be able to get a 20% couples discount at this time. There's also a 5% discount available if both individuals apply and only one is approved, or if only one person in a couple applies. So who qualifies for that discount? This is married couples, civil unions, domestic partnerships, whether they're named in a valid certificate or license issued by a state or not. It's also 2 individuals who are living together for at least 3 years in a committed relationship as partners or family members and are committed to sharing expenses, are not married, and if related, they have to belong to the same generation, so usually siblings. And so where we often see this here in the Midwest, you have 2, a lot of times, bachelor farmer brothers living together in the family homestead after mom and dad retire, and they are, continuing the farm. They share household expenses. They're not married, and they're of the same generation. Those 2 brothers could qualify for the couples discount. The other thing I do like to be very explicit in explaining this, when it comes to civil unions, domestic partners, married couples, same-sex couples are one of those. So yes, Thrivent will insure. So let's talk about some sweet spots, and then I will go off this slide for a little bit of some of the new stuff. So let's talk about some sweet spots real quick. Singles, we're a great fit for singles, especially men, pretty much across the board for men. Again, because it's priced to only pay out if in force for 10 or more years, that return of premium is going to be really affordable with Thrivent. We're really good with younger couples, both from a pricing standpoint and second off because not everybody can insure under age 40. So younger couples were great. High net worth, affluent clients, whatever you want to call them, a lot of them find Thrivent really intriguing. And the reason for that is they appreciate the ability to get these more robust plans, more like the Cadillac plans that you used to design back in the day doing long-term care. You can design, again, up to 8 years each with that shared care, 16 years, plus you can go up to $15,000 a month, plus, oh, if you want, and you can afford it, 5% compounding on top of it. You can design some really robust plans here. Might not be cheap, but you can design something to really accommodate those people that want the best. When you're comparing things apples to apples, if you use something like Stratecision or one of those kind of comparison tools, look at us when you're looking at 5-year benefits in particular. Again, ages 18 to 79 means we can insure a lot more people. Those looking for accelerated payment options. Anytime carrier strength is even remotely an issue, there's, especially in a time when people are concerned about recessions or the economy, things like that, I can't think of any insurer more suited to weather any kind of financial storm than Thrivent. I mean, personally, if Thrivent was having troubles, that means the entire world has now had troubles, is the way I, as Craig, look at it. So now I'm going to go off script here because this next part, and I will get some notes on this to the Golden Care team, but I did not get these through our official compliance department, so my apologies for not having a slide on these. But some of these we did cover in a previous call, but also some of this is some new ground. So I'll get this to Golden Care to share with you. Again, these are some areas we discovered Thrivent fits well. There are some generalities I'm going to discuss, and some of these are going to vary based on other health issues. And please note, none of these are absolute. And the underwriting guide, the field resource guide, producer guide, whatever you want to call it, and the pre-qualification hotline are always going to take precedence. So always consult those first. First off, though, we have a preferred health checklist in the underwriting guide. Not everybody does. It's going to give you a really clear picture on what rate class somebody should come back at, plus that pre-qual line is phenomenal. And then just according to Broker World's long-term care survey that just came out last week, if you haven't seen it yet in Broker World, go online on their website. You'll find a link to it. Some great data in there, including a side-by-side comparison of Thrivent's features versus a lot of our leading competitors. You can see how we stack up on this benefit, that benefit. But what I found really interesting there is they show that Thrivent issues about 4% more cases at preferred than our leading competitor, who I won't name, but you know who they are. Thrivent will look at a history of severe anxiety or depression that others might not, again, based on stability. Look at Thrivent when it comes to conditions like arthritis, AFib, or heart bypass. Take a look at different cancers. Well, we'll look at things like stage, treatment, and stability, but one example I call out is we will consider somebody who is recovered and treatment-free for stage 4 Hodgkin's. Not everyone will. Crohn's is something that Thrivent will consider, whether it's single or multiple flares. Type 2 diabetes is a big one. A1C can go up to 8.5. Now, Thrivent is primarily looking for stability in the condition and in meds and insulin. So as such, they don't list a maximum number of units for insulin. So if insulin is being used, you want to call or email that pre-qualification line with the details. Does family history matter? I know this is a big one. I've heard a leading carrier often will turn down about 30% of somebody's business because they had 30% of them with some kind of family history of cognitive issues. Thrivent does not penalize or auto-decline based on a family history of cognitive issues. So if parents or siblings have dementia or other cognitive issues, take a look at Thrivent. Kind of along those same lines, Thrivent isn't going to automatically decline just based on another carrier declining them. That being said, Thrivent is not just automatically going to issue everybody. You know, if you do have a decline that you think should have gotten issued with another carrier, call the LTCG underwriting pre-qual line, send them an email with all the specifics, and they will let you know whether or not you should take a look at submitting an application. But we have been surprised at some things that Thrivent has issued that other carriers have said no to, and some of it is just based on stability and things like that. So again, no concrete examples I can give you because all of those vary from condition to condition and age and meds and stuff like that. But we will take a look at things depending on what it is, just bounce it off the pre-qual line. And then last and certainly not least, Thrivent is continuing to accept applications at all of its pre-COVID ages. So we've been issuing ages 18 to 79 this entire time we've been in this pandemic. So while other carriers may have stopped issuing ages 65 and older due to face-to-face requirements, Thrivent's done up to age 79 in all states this entire time. And even though other carriers now are lifting those restrictions in many states, I know there are still 13 states where Thrivent should be a go-to if you have anybody age, well, 65 and up. So if you are selling to anybody in California, Kentucky, Maine, Minnesota, New Hampshire, New Mexico, North Carolina, Ohio, Oregon, Pennsylvania, Vermont, Virginia, or Washington, take a look at Thrivent because we are issuing there. But you might have some questions on how Thrivent handles face-to-face assessments during this time. I'll explain it. We've got a great what to expect brochure that you can give to clients as well. But for clients under age 70, no face-to-face interview is going to be required, provided that the client has seen a doctor and had labs done in the past 2 years. So face-to-face assessments are required for anybody 70 or older or at underwriter discretion. So when face-to-face interviews are requested, Thrivent's not going to waive that requirement just because we have a pandemic. So if the applicant is unwilling to complete the face-to-face assessment, they have, concerns about somebody coming into their home, we totally get that. But if they're unwilling to complete the face-to-face assessment, well, then the application is not going to be able to proceed. On the other side of this, though, so far, we haven't encountered any areas in the country where Thrivent cannot find a person willing to go in and conduct that assessment, a field nurse or whatever, to go in and do it. So on the provider of the assessment side, we haven't had any issues. And there have been a handful of people that they didn't understand there might be a face-to-face. So we encourage you, if the face-to-face might be an issue that comes up based on age-based requirements, have that discussion with somebody before applying so that they're not in the underwriting process. You've sold them on the product, you've sold them on everything, and now they hear somebody's going to come into their house and they're not comfortable with it. Be really upfront with it before you even start an application. Tell them that might be an expectation. So now that we've talked about some underwriting niches, some other areas where you should look at Thrivent. 1035 exchanges. So for someone wanting to fund their policy using existing life insurance or annuities, we can help you there. I will get Golden Care a frequently asked questions piece. It's like a 5-page document that walks through all of the details of it. It's a little much to go into right now, but we can do 1035 exchanges. Also, since Thrivent has nationwide pricing, not state-specific pricing, they can be a lot more competitive in some states like Florida or California, where others may have state-specific pricing. So take a look at us in those 2 sunshine states. And then this one I think is kind of cool. Thrivent allows you to increase or decrease a lot of our benefits after issue. So you're going to want to take a look at the field resource guide for full details on all of these, because I'm just going to gloss over these real quick. But I just want to give you an idea of this, because most carriers will for sure let you decrease benefits, 3 years, 5 years, 10 years down the road. But not everybody lets you increase some of the benefits. So these are usually going to require, if you do an increase, they're going to require some evidence of insurability at your attained age, but some things that you might be able to do, and again, all the details are in the field resource guide. But elimination period, you can, 3 years from now, whatever, look at a longer or shorter elimination period. Benefit multiplier, you can decrease or increase that. Your maximum monthly benefit, again, you can decrease or increase it. Your automatic inflation benefit, you can drop from a 5% compound down to a 3 or a 2 or a 1, or you can go the other direction. You can go from a 1 up to a 5. Waiver of home care for elimination period, you can drop or add that rider. Same with the cash benefit rider, you can drop or add that rider. So you can do some things, if somebody experiences a family event down the road where they're like, oh man, I bought a 3-year plan with Thrivent and my dad needed care for 5 years. I should have bought, that 8-year the guy kept telling me about. You might be able to do that here. It's going to be based, again, on their evidence of insurability, and the pricing for that part is going to be at their attained age. But this might be an option where they might have, encountered something and they can't go back and buy it from another carrier or a supplemental plan. Thrivent, they might be able to just increase their coverage. So those are some areas that we think are really different with Thrivent. So Thrivent's quote software is going to be available to any of you through the e-app, and it really does let you do most of this from one screen, so you don't have to toggle through a bunch of multiple screens to get anything done. It is something that you can quote in a tool like Stratus Vision, but you're going to want the full quote with Thrivent because of this function right here. So Thrivent's full illustration software is going to show you the impact of those various FIB selections that I mentioned, and if somebody says, okay, you know what, in my state I can choose it every other year and still qualify, that's what I'm going to do. Still have partnership qualification, but how does that price out? How does it look for me down the road? How does my benefit grow down the road? You can show how that all works here in the illustration software. I mean, it is, if you go down to that customize option at the bottom of that drop-down menu, you can really dial it in. If you want to show, you know what, I want it every other year in my 60s and then every single year during my 70s. You can dial it in as, if you have an engineering person that really likes detailed stuff, you can totally appease all of their requests by giving them a really detailed look at how things play out. Also in the software, you're going to see the column there showing how dividends might affect their future premiums. So again, dividends are not guaranteed, but people would like to understand how it does potentially work to offset some of their future premiums. So you can show, you know what, if he started paying dividends at age 68, how would that look? Well, if your regular premium is $1,600, you now have a dividend of $80 a year, your actual premium that you'd pay is $1,500 and some. So you can show them how that does play out. Again, the illustration software is built right into the e-app. The e-app is built on iPipeline's iGo platform. The Golden Care team can get you access to this. You don't have to be appointed before running quotes or anything. You do want to get appointed before you submit an application. I believe the producer code is required to submit an e-app. But with Thrivent, I highly stress using an e-app if at all possible. The reason, not just because of faster cycle times or no postage or any of the turnaround times with your consumers, things like that, but I'll be honest with you, Thrivent's paper app is a monster. It's about 60 pages plus for a single person. So you have a couple, they don't have a joint application, you're talking 120 pages or more just for a couple. So if you care all about Mother Earth, the environment, trees, things like that, the e-app is the way to go. And it's just because of the way they built the original paper app. It was to satisfy the captive field force, and they had a tool that populated all these various forms. The next generation paper app will be a joint app, and when we get there, we'll have that probably on the next generation of product, whenever that would happen. But at this time, if at all possible, do the e-app. So now to the two biggest questions. How does Thrivent compete on price? When you compare everything apples to apples, we're not going to be the cheapest product out there. Look at us in the context of other strong carriers. That's where you'll see where we really fit. Here I've looked at everything apples to apples and added a few more features to Thrivent than these other leading carriers, and we still give you more bang for the buck. But finally, the last question, how do you talk about the Christian thing and the fraternal? So Thrivent is a fraternal organization that serves Christians, and I'm sorry I've maxed out the time here. As such, there is only one question on the application regarding Christian, and that is at the very beginning, so people don't get all the way through before knowing whether they qualify or not. And the question is very simple. Select one of the following. I am a Christian seeking to live out my faith, or I am the spouse of a Christian who seeks to live out his or her faith. So that's it. No questions about what church someone goes to, how often, anything like that. They don't check whether you're being honest with this question or not. It's an honor-based question. And because of how they've worded the question, you can have people from mixed faith marriages apply, or people even without faith at times get coverage with Thrivent as long as they are married to a Christian living out their faith. So To position this with your clients, we've gotten a piece put together called Thrivent 101. It gives this approach we've used for 4 years to tee this up by putting your client in charge of whether you can proceed with the conversation or not if you're unsure of their faith. This doesn't offend anybody. It works really, really well. You keep it really simple. You just say, I have a few different solutions we can discuss. One is from a fraternal organization called Thrivent. They're a top-rated financial services organization formed to serve Christians. I don't know if that's going to work for you. And you know what? If that doesn't, that's okay. I've got a few other products we can discuss. And at that point, shut up. Let them give you direction. They'll either say, you know what? Tell me more, or that's not for me. It's not going to work. What else do you have? So keep it really high level there. So on a related note, while you do have to be Christian or married to one to buy Thrivent, you do not have to be Christian to sell Thrivent's product. So to help you get started with Thrivent, because we've been seeing some really great traction with Golden Care, we're extending our special launch incentive that we actually kicked off back in March. So we've now changed it so you have until the end of August to submit applications on Thrivent, and if those are enforced by the end of October, you will receive an extra $250 per life. Again, the policy has to be enforced and paid by 10/31. There is no cap to this incentive, so you can just keep racking this up. I believe this is one of the most generous incentives we've seen in traditional long-term care in a long time. These incentives will be paid in December 2020, but you have a couple. They both apply. They're both issued, both paid. Right there, there's $500 extra because you gave them a product, and it's a product they're going to be happy with because it's from this really benefit-rich solution, fraternal insurer, and it's one, again, that they feel good about because they see that insurer doing good out in their communities. So with that being said, just contact your Golden Care support team and they will get you started.
Hey, no problem, no problem. Great presentation. Thank you much for your time. And we will be reaching out to everybody that was on the call today, but most importantly, give us a call at 800-842-7799. 800-842-7799. I was an agent for a long time, in fact still am, and I know how it is out there. You intend to do something, but your desk gets full, your plate gets full, and you put it off, and it doesn't happen. Let's get moving on this. Get signed up for Thrivent and any of our other products. Let us help you. We have plenty of support here. It's a perfect time to be in the long-term care situation. We've had more agents tell us that old clients or people they thought were going to be a client are now calling back and say, boy, I really want to take care of this. And it's too bad the COVID thing's going around and actually very dangerous thing out there and hurting people, but it's especially dangerous in the long-term care situation. So let's help keep our clients out of a nursing home if we possibly can, and in the long run make sure we protect their assets if they do end up there. So thanks everybody. Craig, I want to thank you again. Nice presentation. Everybody have a wonderful day. Thanks, Craig. Yep. And feel free to give us a call anytime. 800-842-7799. Take care, everyone. Have a great day. And